In this video, we're going to discuss valuing stocks. What is the process for determining or predicting what the value of a stock is currently? So let's start this off with a basic idea of dividends and yields, etc. So the return on a stock has two component parts. The dividend yield, D1 divided by the current price, plus a capital gains rate. So the total return of a company on their stock is the dividend yield plus the capital gain rate. The expected return should be equal to the expected return of any other investments available in the market with equivalent risk. So equivalent risk things should provide very close the same kind of return. So if you were going to invest in Walgreens, right, we think that Walgreens is going to pay a dividend of $1.40 and it's going to trade at $80 at the end of the year. If similar risk investments earn 8.5%, what's the most you'd pay on the stock? So the formula, again, right here, here's our formula. You take D1 plus the future price that you're predicting, and you divide it by 1 plus the required return. So this stock should be worth today roughly $75.02. Now let's kind of break this down into those two component parts. The dividend yield is $1.40. That's the dividend divided by the current price. 1.87% is the return that you earn on the dividends. The capital gain, if it grows to $80, $4.98, and that turns out to be a capital gain percentage of 6.63%. Add those together, that's the 8.5%. So again, this 8.5% is the 8.5% the expected return. So it works out that this the return that you expect to get is equal to the risk-adjusted return that you expect to receive in the marketplace. So if you want to hold on to this stock for N years, then how do you find out its present value? The price of any stock is equal to the present value of its future cash flows. Well, we can go out to N years, but the problem is this N obviously changes depending on the person, time, etc. If we make a couple of assumptions, and the first assumption we're going to make is that stocks have an infinite life. If that's true, then the present value of a price at infinity in today's value is 0. You can just trust me on this. If you find the present value of any number, let's say, what's the present value of $100,000 in 1,000 years? Figure out what that is. Use an inflation rate of 3%. You're going to find out it's a very, very low number. And infinity is obviously much farther away from N, right? The thousand years. It's so the present value is going to be 0. That leaves us then with just the present value of all future dividends. The challenge here is that we can't do anything to infinity, right? Infinity, it's difficult to do that. So how can we adjust this, or how can we come up with a formula that we can use? So the formula that we use requires another assumption. We already have that the life of a stock is infinite, but now we're going to assume that we have a constant dividend growth. That whatever the dividend growth is, it is that way to infinity. If that's true, this previous formula simplifies algebraically to this formula. The value of the stock, again, D1, that's next year's dividend, what you expect it to be, divided by the required return on equity minus the growth of dividends, the expected growth of future dividends. And we can simplify this a little bit by simplifying the numerator here. If you know today's dividend, and of course we do because it's paid to us, here's the growth rate. We're assuming this growth rate is constant into the future. So again, the value of the firm depends on the current dividend level, the cost of equity, and the growth rate. Now, the cost of equity also incorporates, from previous chapters and videos we've talked about, incorporates risk. So risk is involved here. So here we have a company, it's a regulated utility. It plans to pay $2.30 per share in dividends in the coming year. Equity cost of capital is 7.5%, and dividends are expected to grow by 1.5% per year. So we can plug this in. Now, if you read this problem, it says that we expect it to pay $2.36 in the future. That's D1. Well, in our formula, we're going to have D1, but in this case, it is a formula itself. So down here, for this particular type of problem, and then this is just an illustration, right, of how we would do this. But if you know D1, you plug it in here, that then obviously plugs in up here. The growth rate's 1.5%, and K sub S, right, that is the a required return that we're told. This stock has a value of $39.33. Well, if you expected this stock to sell for $59, I mean, would you pay $59 for something you thought was worth $39? And the answer, of course, is no. Also, if you calculate the expected return, if you paid $59, you'd earn roughly 5.5%, but you required, right, the required return that you want, the cost of equity, is 7.5%. So if you wanted 7.5%, you never would buy the stock if you were going to get 5.5%. So let's expand this a little bit further. You recently were paid $3, and I'm sorry, let me go back real quick. Remember that when you're done with this kind of problem where you're given D1, you have to delete this cell because this is a formula. And this formula says if this number is 0, do X and X and X. If it isn't 0, then put that number here. So your future problems will be incorrect if you don't fix that. So you just have to remember. So here we have $3 dividend is what was recently paid. That goes in this cell down here for D0. The growth rate, 7%. You plug that in. Required return of 16. So this stock has a value of $35.67. The current stock price is $37. Would you pay $37 to get $35? Obviously, you would not. If you did pay $37, you would only earn 15.6%. But given the riskiness of this asset, you would want a minimum of 16%. So again, this just tells us that this stock is not a good investment at this time. So how can we incorporate this concept of growth? So let's think about how this works. The dividend payout ratio is the fraction of earnings paid out. So it's earnings, right, net income, divided by shares outstanding. If you multiply that times the payout rate, that will tell you what the dividend is. So how can a company increase its dividends, right? Well, there's only two ways. You have to either increase this earnings per share number, or you have to increase the dividend payout rate. Those are the only two ways you could do that. How can you increase earnings per share? Again, there's only two ways. You either increase earnings or you buy back stock. All of those, if you change this number, dividends change. If you change this number, dividends change. So a firm can do two things with its earnings, and this is how this all incorporates into the growth of the company. If the company pays its earnings out as dividends to its investors, then it doesn't have this cash to reinvest and grow the company. So the only other alternative is to retain it and reinvest it. So this is these are the dollars that we're interested in talking about. What happens when you reinvest the funds of the company? So here we have the change in earnings of the company is whatever that new investment is times the rate of return on the new investment. So if you invest more money and you know what the return is, you understand about the change in earnings. So the new investment, if you solve for this, is the earnings multiplied by the retention rate. So that retention rate, again, just coming back, that's the fraction of earnings that's actually retained. So the earnings growth rate is the change in earnings divided by earnings. And that equals now the retention rate times the return on new investment. This is actually a number we know. This is return on equity. What is, when a company and when investors invest their money, what rate of return are they earning on their investment? This is the number we use to calculate the growth rate. So if you take the retention rate and multiply it by that return on equity, that is G. So if the company keeps its retention rate constant, then the growth rate in dividends is going to equal the growth rate of earnings. So this actually, predicting future dividends is rather difficult without this assumption, right? So we need to understand that companies don't change their dividends very often. So if they're not changing their retention rate, that is, they're not changing their dividend payout rate, then we can't assume that future earnings growth, if we can predict that, is going to be equal to the growth rate of dividends themselves. So if a firm wants to increase its share price, here's the question. Should it cut its dividend and invest more, or should it cut the investment and increase its dividend? And the answer is going to depend on the profitability of the firm's investments. So cutting the firm's dividend to increase investment will raise the stock price if and only if the new investments have positive net present value. Again, we've been talking about net present value, how it is a measure of the growth or the increase in wealth of the company. So again, should you cut the dividend? The textbook says if and only if new investments have positive net present value. Now this red is me talking about. I want to add a little caveat to this rule. That is exactly true, but if and only if there is information describing why they want to do this. You just can't cut the dividend and not tell anybody why you're going to cut the dividend. We will consider or talk about this in detail when we get to the dividend policy videos. So, I don't want to get into describing in that too much detail, but we have to tell people what we're doing so they understand why we're reducing their cash flows. So here's the information that I gathered this past year or so on Molson Coors. So this is the dividend discount model for Coors, TAP. And this is the information we need to know. Risk-free rate, what is the average rate of return in the stock market, what is the beta of the company, what is its dividend yield, what's the return on equity, dividend payout, right? How much do they pay out? This obviously means 42% is retained. And here is the dividend history from 2008 to 2012. So let's plug this into our formula and see what happens. So here is the worksheet. It's the stock valuation constant dividend model. And here we see where we put the information. Here are the formulas up here. 10%. Whoops, I'm sorry. I should have changed this back here. Sorry, I changed this number. Let me change that now so future people get it right. So 10% is the required return. How do we know the growth rate? Well, let's go down here and see. We can do it with the time value of money. Started out at 84 cents, $1.28 is D0, and N equals 4. How you do this is you just subtract. 2012 minus 2008 is 4. That means there are 4 growth periods. Oops, sorry. So this says that the growth rate is roughly 11.18%. We can also use this earnings growth rate retention model that we just talked about. The dividend payout ratio is 58%, and we have the return on equity as 5.07. And I got that from my financial data on the company. That means the retention ratio is 42%, and the growth rate is 2.13%. Now, we obviously have 2 different answers because there's 2 different theories at work here. What we'll typically do is take the average. Now, there's a big swing here in the difference. But again, 11 and 2 is 13. Divide that by 2 is roughly 6.5%. Now, as investors, we need to look at that and try to understand exactly, is 6.5% a good number? I mean, maybe we want to downplay this a little bit. Let's say, maybe 6.5. Maybe it needs to be 4.5, right? We can change that because it's our numbers, right? But typically we'll take the average. How do we find the required return for this stock? Well, there's 2 ways. We can use the security market line formula. Risk-free 3.67%, return on the market 12, betas 0.93. So that gives us 11.42% is the required return using security market line. If you use the dividend yield capital gains model, then we have 9%. One thing just to mention, depending on the textbook that you use, K sub S is also K sub E, right? I'm not sure why K is used. Sometimes, or excuse me, not K sub E, R sub E. So return on equity and K sub S. K sometimes is the variable used for returns. So it could be either one. Anyhow, 9%, 11.42%. I took a rough average there and said it's 10% is the required return on this stock. So the value of this stock is 38.95%. Again, we can we don't know whether that number was right or wrong, but we can go back and check that, obviously, if we wanted to. I don't know that we need to beat this into the ground anymore. It's a rather simple model once you gather the data. And throughout some of our videos, we've talked about how you gather the data for historical prices, for historical dividends, etc. So we can't use this constant dividend growth model if the growth rate's not constant. There are certain kinds of companies, think about technology, where the growth rates change frequently on their earnings, mostly because of innovation. So they may have some high growth periods, and again, what they will do in the end is, as competitors figure out what they're doing with this innovation, they will reduce the profits that the company have, because essentially with innovation, you have some monopoly power. And eventually that is eroded with competition. So here we have an example of what they refer to as a differential growth variable. I learned this way back when as something called the supernormal growth stock valuation. So here we have an innovative process, right? They're going to be able to increase dividends above their normal rate of 12% for the next 4 years. After that, the growth rate is going to return to the industry standard of 9%. Most recent dividends 4.25%, and the company's cost of equity is 20%. So again, when you plug this into our formula, and again, just as a note that here that goes 1 through 7, the next one's 15. That's because I hid some of these lines here to make sure I could get this all on this one particular slide. So if you look, what this does is it calculates the present value of the dividends in that growth period for the next 4 years, right? So here are the dividends, and what happens after that? 5 goes to 0 because there's no dividends after that. Here are the dividends. So the present value of those dividends is $14.35. The future price at the end of 4 years is expected to be $31.95. That's its present value. So you add those together, present value of the dividends, plus the present value of the future price, we end up with $46.31 is the expected present value of this stock. So there's a lot of uncertainty with forecasting dividend growth rate and future dividends. It's part of the issue, the challenge of investing, right? Is that you need to understand what that growth rate is. And small changes can lead to large changes in estimated stock price. As a investor, if I were doing this, I wouldn't rely only on one growth rate. I might look at, well, what is the best possible growth rate and what is the worst possible growth rate, and find an average somewhere in the middle. So at least you'll know the upper and lower ends maybe of this future, of the current stock price, and then you can make a decision to buy or not buy. Look forward to seeing you in the next video.